In 2026, a Tesla Model Y will cost you $3,836 just to insure it every single year. Add that up over 5 years, and you're looking at nearly $20,000 in insurance alone. That's before depreciation, charging, maintenance, and everything else. Today, I'm going to show you why Tesla has quietly become one of the most expensive cars you can actually own. And more importantly, why you should probably buy something else instead. Most people think about the sticker price when they buy a car. They see that a Tesla Model Y starts around $50,000 and they compare it to a Honda or a Toyota. But that's only half the story. The real story is what happens after you drive it off the lot. Because owning a Tesla isn't like owning a normal car. It's a completely different financial equation, and almost nobody is talking about it honestly. Let's start with insurance, because this is where the Tesla dream starts to get expensive. Most car owners budget maybe $150 to $200 a month for insurance. That's if they're driving something normal. If you own a Tesla Model Y, you need to budget over $300 a month. $319 to be exact, every single month. That's $46, more than the national average for all vehicles. But here's where it gets worse. If you buy a Model X, you're looking at $4,529 per year. If you buy a Model S, it's somewhere between $3,000 and $5,000 annually. Compare that to insuring a comparable BMW or Mercedes, and you're paying anywhere from 15 to 25% more just for the Tesla badge. Why is insurance so expensive for Tesla vehicles? It's not because they're more likely to get stolen, though that's part of it. The real reason is that Teslas are incredibly expensive to repair. When you get in a minor fender bender in a normal car, a shop can fix it in a few hours. When you get in the same fender bender in a Tesla, suddenly you're looking at major complications. Tesla's entire body structure is different. They use unibody construction, which means structural components are integrated into the frame. When anything gets damaged, the entire structure might need realignment. Beyond that, there are hundreds of cameras, sensors, and computer systems embedded throughout the vehicle. After any bodywork, all of these systems need to be recalibrated. A fender bender that costs $800 to fix on a Toyota costs between $1,800 and $2,500 on a Tesla. That's triple the cost. Insurance companies know this. They know that parts are scarce, that labor costs are high, and that specialized tools are required. So they charge accordingly. When you're buying a Tesla, you're not just paying for the car. You're paying for a lifetime of expensive insurance premiums. But insurance is only the beginning. The next financial killer is depreciation. And this is where the math really starts to get ugly. When people talk about electric vehicles, there's this persistent myth that they depreciate faster than gas cars. That used to be true. But in 2026, the picture is more complicated. Some EVs are actually holding their value reasonably well. Tesla Model 3s and Model Ys, in particular, depreciate slower than many non-Tesla EVs. But that doesn't mean they hold their value well, not even close. Consider this. A Tesla Model Y that costs $60,000 new will be worth roughly $36,000 after 5 years. If you put 12,000 miles on it annually, that's a loss of $24,000. Over a 5-year period, that means you're losing $4,800 per year to depreciation alone. The Cybertruck, which is Tesla's newest vehicle, loses $41,417 over 5 years. That's $8,283 per year just gone. Poof, evaporated. Now let's talk about total cost of ownership, because this is where everything comes together and the picture becomes genuinely shocking. Let me walk you through the 5-year ownership cost of a 2026 Tesla Cybertruck. Year 1, you're paying $28,151 when you account for insurance, fuel, financing, depreciation, maintenance, and registration fees. Year 2 drops to $16,465. By year 3, you're at $14,994. After 5 years, your total cost to own that vehicle is $84,504. Over $16,000 per year in total ownership costs. Think about that number for a second. $16,000 per year. That's not just the payment on the car, that's everything. That's your insurance, your electricity, your maintenance, your repairs, and the value your car loses every single year. For comparison, a 5-year ownership cost on a Honda Civic sits around $40,000 total. That's $8,000 per year. A Toyota Corolla is similar. Even a BMW or Mercedes, which are supposed to be expensive luxury cars, often come in cheaper than a Tesla when you calculate the full cost of ownership. This is absolutely crucial to understand, because most people are focused on the monthly payment. They see a Tesla payment of $550 a month and think that's affordable. But when you add in $320 for insurance, maybe $100 for electricity and charging, and then watch that car lose $41,000 over 5 years, suddenly that affordable monthly payment looks like a financial disaster. Now, here's where it gets even more interesting. The margins on Tesla vehicles are collapsing. In 2025, Tesla engaged in massive price cutting to hit sales targets. They wanted to show record shipments and high delivery numbers, but the problem with cutting prices is that it crushes your profit margin. Tesla's recent financial results show sales were up, but profits were moving in the wrong direction. Revenue increased, but net profit declined. This is the nightmare scenario for any automaker. You're selling more cars, but you're making less money on each one. The reason this matters is because Tesla stock has become extremely overvalued, based on the assumption that the company would grow infinitely. Investors aren't buying Tesla because of the cars it sells today. They're buying it because they believe Tesla will become a transportation and artificial intelligence company of the future. They're betting on robotaxis and humanoid robots and autonomous vehicles. But here's the problem. Those products don't exist yet. They're promises. And Tesla's current business, selling electric vehicles, is not as profitable as it used to be. In fact, let's talk about Tesla stock for a moment because this is relevant to the broader picture. The stock was down 31% year to date as of late July 2026. The company's valuation, which sits at a price-to-earnings ratio of 373, is completely disconnected from the company's current financial reality. To put that in perspective, the average price-to-earnings ratio for a normal car company is between 5 and 10. Tesla is trading at 35 to 50 times more expensive than that based on current earnings. Wall Street analysts are valuing Tesla based on future promises. They're assuming that full self-driving technology will work. They're assuming that robotaxis will be profitable. They're assuming that a humanoid robot called Optimus will become a commercial product. But none of these things exist in any meaningful way right now. Meanwhile, the core business is struggling. Vehicle sales are under pressure. In 2025, Tesla's delivery growth slowed dramatically. At one point, deliveries were shrinking by 13% compared to the previous year. The company only recovered in the third quarter because American consumers rushed to buy cars before a federal tax credit expired. That's not organic demand. That's demand pulled forward from the future. What happened in the fourth quarter? Weaker deliveries, because those customers had already bought their cars. Going into 2026, Wall Street analysts expected only 15% top-line growth for the company. That's not great for a company that's valued like it's going to grow 25 to 30% per year. And here's the kicker. To support all of these future growth initiatives, Tesla is planning to more than double its capital expenditures. They're going to spend $25 billion this year on factories, technology, and research. That's 3 times what they spent in 2025. And because of that massive spending, analysts expect Tesla's free cash flow to be negative in 2026. The company will burn cash. They'll spend more money than they make. Let me put this bluntly. If you're thinking about buying Tesla stock in 2026, you're making a bet that feels like the tech bubble of 1999. You're betting that unproven future technologies will transform the company into something completely different. You're betting against current financial reality. And you're betting against a CEO with a track record of overpromising and under-delivering on timelines. But let's get back to the cars themselves, because that's really what this is about for most people. If you're considering buying a Tesla in 2026, you should know that you have better options than ever before. This is the crucial part. For the first time, Tesla's market share is actually declining. It dropped from over 55% of the EV market to 48%. Why? Because competitors have finally figured out how to make good electric cars. And some of them are better than Tesla's offerings. Take the Nissan Leaf. The 2026 Nissan Leaf is completely redesigned, and it starts at just under $30,000. That's nearly $30,000 less than a Model Y. The range is competitive now, with up to 303 miles per charge. The seats are comfortable. It has real buttons and physical controls instead of Tesla's touchscreen-only nightmare interface. And it's incredibly affordable. For someone who wants to drive an electric car without spending a fortune, the Nissan Leaf is objectively a better choice than any Tesla. If you want something sportier, look at the Kia EV6. It starts at $42,900, which is substantially less than a Model Y. It has a more dynamic driving experience than the Tesla, with suspension tuning that actually responds to road feedback. It uses an 800-volt architecture that allows faster charging than Tesla's system. It has real NACS charging compatibility, and it's rated 8.8 out of 10 by major reviewers, the same as the BMW i4. That's about as good as it gets. Then there's the Hyundai Ioniq 5, which is positioned as one of the best value EVs on the market. It competes directly with the Model Y, but offers superior charging speeds, better interior ergonomics, and aggressive pricing. The Ioniq 6 is an alternative to the Model 3. For anyone who values responsive steering and comfort over minimalist design, the Ioniq 6 is probably a better car, and it costs significantly less. If you want maximum range, look at the Lucid Air. It offers up to 516 miles of range per charge. That's more than any Tesla. It's a luxury sedan that competes with the Model S. And while the Lucid Air is expensive, it delivers more value in terms of range and interior quality. For truck lovers, there's the Rivian R1T. It's purpose-built for adventure and off-road capability in a way that the Cybertruck simply isn't. The Cybertruck looks futuristic, but it's not actually a good truck. It has a tiny bed, terrible visibility, and an awkward design that prioritizes looking unusual over practicality. The R1T is the opposite. It's a real truck that happens to be electric. For budget-conscious buyers, the Chevrolet Equinox EV starts at $33,900. That's an honest-to-God 3-row crossover with decent range and charging access through the Tesla supercharger network for $34,000. Here's what's remarkable about 2026. There are now legitimately good electric vehicles at every price point. You don't have to buy a Tesla, you have choices, real choices. That's new, that wasn't true even 2 years ago. Now I need to address something, because I know what some people are thinking. They're thinking, well, sure, Tesla cars are expensive to own and the stock is overvalued, but Elon Musk is a genius and he's going to pull off something amazing. Maybe he'll launch the robotaxi. Maybe the Optimus robot will work. Maybe full self-driving will finally become reality. Here's the problem with that line of thinking. Elon Musk has a very consistent track record of overpromising and under-delivering on timelines. He said full self-driving would be solved years ago. It's still not solved. He said the Cybertruck would come out in 2021. It came out in 2023, and it's been plagued with problems. He said the Semi would be in mass production. Production is trickling. He said humanoid robots would be commonplace. We're nowhere close. And that's not inherently a criticism of Elon Musk. Ambitious people often overpromise. They dream big. They announce things before they're ready. But if you're going to invest in Tesla stock or spend your hard-earned money on a Tesla vehicle, you need to base that decision on current reality, not future promises. The current reality is this. Tesla vehicles are incredibly expensive to own when you factor in insurance, depreciation, and maintenance. Tesla stock is priced for a future that hasn't arrived yet and may never arrive in the way that investors expect. The company's core business is facing intense competition and margins are being crushed. And there are now better alternatives available at every price point in the EV market. Let me address one more thing, because this is important. Some people will say that Tesla's charging network, the supercharger network, makes it worth buying a Tesla. Yes, Tesla's supercharger network is extensive and generally works well, but that advantage is evaporating. Hyundai and Kia vehicles now have NACS compatibility and can use the supercharger network without an adapter. The Chevy Equinox EV has supercharger access. Other manufacturers are rapidly adopting the same charging standard. Within a year or two, the supercharger network will be a commodity, not a differentiator. So what should you actually do if you're thinking about buying an electric car in 2026? First, be honest with yourself about your actual needs. Do you need a car that charges at home? Then an EV might make sense for you. Do you have access to home charging? Are you willing to learn how to manage charging and range? Are you comfortable with the learning curve of using software-first controls? If the answer to all of those is yes, then an EV could work for you. But if you're expecting an EV to be just like a gas car but with better performance, you're going to be disappointed. Second, shop around. Don't just assume that Tesla is the best option. Look at the Kia EV6. Look at the Nissan Leaf. Look at the Hyundai Ioniq 5. Look at the Chevy Equinox EV. Drive them. Compare the insurance costs. Look at the real-world ownership costs. You might be shocked to find that a $50,000 purchase price on a car with $300 monthly insurance is actually a worse deal than a $35,000 car with $200 monthly insurance. Third, if you're interested in Tesla stock, be very careful about your expectations. This is a company in transition. It's moving away from being a pure automaker toward being something else. That's a risky bet. The company is spending enormous amounts of money on unproven technologies. The core business is under pressure, and the valuation assumes that everything works out perfectly. In reality, there's a very good chance that things don't work out that way. And if they don't, the stock could fall significantly from current levels. This brings me to the uncomfortable truth that nobody wants to acknowledge. Tesla's moment as the clear leader of the electric vehicle market is over. It ended in 2025. By 2026, it's already becoming obvious. The company has faced intense price competition, margins have compressed, growth is slowing, and competitors have caught up. In some cases, competitors have passed them. The Tesla Model 3 used to be the only good electric car you could buy at that price point. Now you can buy a Nissan Leaf that's cheaper and more practical. The Tesla Model Y used to be the only good midsize electric SUV. Now you can buy a Kia EV6 that's better to drive and cheaper. The Tesla Model S used to be the ultimate luxury EV. Now you can buy a Lucid Air with more range and a nicer interior. On every front, Tesla is being challenged. And the thing is, this was inevitable. Tesla was always going to face competition. That's how capitalism works. You can't have a monopoly on an entire category forever. Eventually, better capitalized companies with more manufacturing expertise will figure out how to do it better. That's what's happening right now. The companies that benefited most from Tesla's pioneering work are probably Hyundai and Kia, which are part of the same parent company. These Korean manufacturers have decades of experience building reliable vehicles. They have manufacturing expertise, they have dealer networks, they have customer service. When they decided to invest heavily in electric vehicles, they were able to leverage all of that existing infrastructure. And they've created products that are genuinely competitive with or superior to Tesla's offerings. German automakers like BMW and Mercedes were slower to react, but they're catching up fast. Ford and General Motors are investing massive amounts in electric vehicles. And Chinese manufacturers like BYD are making incredible strides. Tesla's first mover advantage is gone. The company is now competing on equal footing with companies that have more resources, more manufacturing expertise, and more reliable track records. Here's what I think is going to happen over the next few years. Tesla is going to become more like a normal car company. Its growth rate will slow. Its stock price will probably decline significantly. The company might develop a successful autonomous vehicle or robot, but it's going to take longer than people expect, and it might not be as profitable as the hype suggests. And by 2030, Tesla will probably be the number 3 or number 4 electric vehicle manufacturer globally, not the clear leader. For consumers considering buying a Tesla in 2026, the calculus has changed. You're no longer buying a revolutionary vehicle that no one else can match. You're buying a premium electric car from a company that's increasingly just another automaker. And when you look at it from that perspective, the value proposition becomes much weaker. Why pay $60,000 for a Model Y with $300 monthly insurance when you can buy a Kia EV6 for $43,000 with $200 monthly insurance? You're saving thousands of dollars and you're getting a better driving experience. That's not a hard choice. Let me be clear about one thing though. I'm not saying that owning a Tesla is a bad decision for everyone. If you're a wealthy person who loves electric cars and doesn't care about the insurance costs or depreciation, then go ahead and buy a Tesla. The company still makes excellent vehicles. The performance is incredible. The technology is impressive. The brand is cool. But if you're a normal person trying to make a financially responsible decision, you need to understand what you're actually paying for. You're not just paying for the car. You're paying for expensive insurance. You're paying for rapid depreciation. You're paying for a company that's in the middle of a major transition with an uncertain future. You're paying for brand cachet that's fading. And you're paying a premium for features and performance that you can get from competitors at a lower price. The 2026 car market has fundamentally changed. For the first time since Tesla launched the Model S in 2012, there are genuinely better options available. This is new, this is important. And if you're thinking about buying a Tesla, you need to know about it. So here's my final message. If you're considering an electric vehicle, do your research. Compare the Nissan Leaf, the Kia EV6, the Hyundai Ioniq 5, the Chevy Equinox EV, and yes, the Tesla Model 3 and Model Y. Look at the insurance costs. Look at the depreciation. Look at the real-world ownership expenses. Consider your actual needs, and then make a decision based on facts, not brand loyalty or hype. If you're considering Tesla stock, remember that you're making a bet on the future, not on current financial performance. And that future is incredibly uncertain. The company is spending enormous sums of money on unproven technologies. The core business is under margin pressure, and the stock is priced at levels that assume everything goes perfectly. If you're going to buy Tesla stock, do so with your eyes wide open about the risks. The bottom line is this. In 2026, buying a Tesla no longer makes as much sense as it did even a few years ago. The financial math has changed, the competitive landscape has changed, and consumer options have improved dramatically. Tesla is still a good car company making good vehicles, but it's no longer the only choice. It's not even the best choice for most people anymore. And that's the most important thing you need to understand if you're thinking about buying one.